Without further ado, I'm delighted to introduce David Lind, CEO of Lind Living, who will be moderating our first session. SFR Property Management State of Play: Will Industry Growth Continue? Evaluating the Changes in Property Management Lessons Learned. Thanks, David.
Thank you very much. Hi, everybody. I'm glad everybody's here today. This is my first moderating gig, so don't be too harsh on me. Glad everybody could make it with all the craziness and hurricanes and things going on in the world. So this morning we're going to talk about a lot of topics. And first I'll introduce myself. My name is David Lind. I'm the CEO and president of the Lind Company. We have a BFR vertical that has about 6 projects going, with another 4 right behind it in Texas, in Florida, and in the suburbs of Chicago. We operate about 20,000 units. We're primarily traditional multifamily players. And just like all of you, when this space blew up and got big, we looked at it as originally a fad. My concern, along with a lot of my colleagues, was, is this just something that the BlackRocks and the Blackstones of the world are just taking all these houses that they couldn't sell for subprime and creating a market out of it, and it's going to be a fad that's going to go away? And clearly I'm sitting on this panel today, so I obviously believe in it. And we're going to have a lot of topics that we're going to go over this morning. So without further ado, I'm going to go start with Jackie, and their panel is going to introduce themselves and give you a little background, and then we're going to jump into the topics.
Awesome. Thanks so much, David. I'm Jackie Lee, CEO of Brandywine Homes. Brandywine Homes operates over 3,000 units over 9 markets. We're very heavily invested in build-for-rent communities. We actually have 13 build-for-rent projects on the ground right now and continuing to grow. We started off, like David, not multi, but scattered site. Saw the shiny star in the room of the build-for-rent and went full force into it. So it's been really going wonderful for us. We're excited to continue in this space. Over to you.
Thanks. John Hirschfeld, Chairman and CEO of Home River Group. We are a third-party property manager, largest in the country, I believe, 37,000 units under management in 30 states and 60 markets. We've recently also gotten into the investment management business in a meaningful way and are investing our own capital and that of an institutional partner. In a lot of our markets, we have 600 employees around the country, another 100 or so offshore. Expect to be well over 40,000 units by the end of the year, and really inspired by how this industry is going. Happy to be on this panel.
Hey everybody, I'm Chris Poston. I work at Darwin Homes, and I lead the acquisitions and asset management functions for Darwin Homes. For those of you that don't know, Darwin is a vertically integrated SFR investment platform. We do everything from asset management, acquisitions, renovation, and property management across the spectrum, and we've got about 6,000 homes under management today across the U.S. I think we're in 15 or 20 markets.
Awesome. Good morning, everyone. Mike Ramin, Executive Director of Sales for Sharestates. We are a direct private lender. It's national. We help real estate investors with fix and flip, mixed use and multifamily bridge and value add, commercial, office, retail and warehouse, and rental loans. So DSCR rental loans in the 1 to 4 family space, portfolio space, multifamily and mixed use as well for DSCR. And we do ground up construction. So a lot of build to rent as well, still going on in the market.
All right, guys, so first I'm going to start off a little exercise this morning, and when I talk about any topics, as we said originally, is why now? Why has this space grown so much? Why is he going to be at 40,000 units at the end of the year? Why are these guys getting in investment management in the BFR space? And so with that, the first thing I'm going to ask you to do this morning, it's a little corny, but I'm going to ask everybody to close their eyes for a second. So just close your eyes for a second. Don't fall asleep, but just close your eyes for a second. And think about some of the most amazing events you ever had as a child or a friend growing up for 4th of July, Halloween, Christmas, Hanukkah, all of those memories that you're thinking about right now. Now you can open your eyes so you don't fall asleep. But all those memories that you replayed in your mind were centric around a home. A home. Usually not an apartment, usually a home. And a home can mean various things, but when you gather at grandma's or grandpa's or the aunt's or whatever, it's usually a home so everybody can fit. And everybody spends the rest of their life trying to replicate those memories and those feelings. And that's what we're talking about here, and that's what differentiates this product versus an apartment, is it's a home. And so one of the things that I found when I researched this space is the stat I found that really drives it all, and then I want to hear my panelists' opinions as well, is I settled in on the fact that 45% of all renters wish they could own a home and cannot afford one. That's why subprime was as big as it was. And in my opinion, this space fills what subprime was. People who want a home, can't afford one, and instead of owning one and buying one, we're essentially renting them. And it's the next step in evolution to owning a home, because now this is a professionalized thing. So I'm going to start with Jackie. Why don't you go ahead and give your opinions? I mean, you guys got into the space. What were some of the reasons why you guys decided to jump in and believe in it?
Sure. I think a lot of the same reasons. Everybody wants a home. And when we were looking at the scattered site inventory, there wasn't a lot of community either. And a lot of people were looking for community. So we began building these build-for-rent communities where people could live and work. But the pandemic really did push people to want to be out in the suburbs, have that whole community feeling, and work from home pushed that too. Everybody needed more space. So that pushed us even harder into build for rent as people were wanting offices and places for their children. And we knew that we could provide that for them and create those spaces that people are looking for. And that's really helped build the push to build for rent for us.
John, interested to hear your perspective on this, given you guys have grown so fast and are acquiring so much. Clearly you guys have your reasons. So.
Sure. Well, I grew up in an apartment in New York City, and it felt like a home to me.
Home is where your heart is.
Yeah, home was where your heart is, exactly. Yeah. But we did have a little house in the country, which made me a little bit more balanced than otherwise. So I think that's right. I think home ownership has always been the American dream for obvious reasons, emotional, financial, etc. And I also am not actually sure it's coming back anytime soon for some of the reasons you mentioned, but also because the rental experience, I think, is getting better and better because of people in this room. And I think in terms of why I got into the business, I'm like some of my brethren in the industry that have gray hair. I'm from the commercial real estate industry originally, and investment banking and law and things like that. And we just looked at this business in 2013 and said, this is by far the largest unconsolidated asset class there is, and it's enormous. It's also very fragmented, very inefficient. There's a huge opportunity to add value here through technology, et cetera. And if people in this room and us on the panel and our colleagues out there can help make that industry act more like an apartment building in terms of its efficiency, it can become a real institutional asset class where we can use all the good stuff, economies of scale and everything, to bring value to investors and residents and so forth. So to me, at this point in my career, it just looked like a great opportunity to take all the lessons and skills I learned in contacts in the industry. So that's why I got into the business.
Chris?
So contrary to John, I actually grew up in the SFR space. I have a career prior to doing this, but I've been in the space for about 10 years, starting on the private equity side in what I call round one of capital deployment. And so I view the SFR industry as having two distinct shifts. There's been a recent shift, which I'll talk about, but the first one was devalued assets. We were buying homes that were foreclosed on for pennies on the dollar the first time around. And the play was just go buy it and hope they return to normal and I'm going to make a ton of money. I'll figure out property management some way down the road. That was the first trade. I call it a trade, not a fad. It was get in, trade the assets like buying devalued stock, wait for the value to return to the mean, and we get out, we're good, we made our return. What came out of that was like, oh, hey, these assets actually really have strong cash flow. They're really a good yielding asset. There's some resiliency when the economy hits some shocks. So maybe this is a long-term play. So now the capital partners that we're working with are things like pension funds, insurance companies, sovereign wealth groups that are excited about cash flow, less about achieving yield or achieving return through asset appreciation, more achieving yield through cash flow and long-term hold strategies. And again, kind of like what the panel has been alluding to, is improvements in operational efficiencies, the ability to squeeze margins and drive more operating cash at higher performance levels, better collections, better leasing timelines. Those are all things that are enabling new capital to enter the space. And that's been really, really interesting. And those are the reasons why this is an asset class. John mentioned this is one of the most unconsolidated asset classes in the country. I think the most densely institutionally owned rental market in the US is Atlanta. It's like 13% of the rental properties are owned by an institution. So if you think about that, that's the most densely institutionally owned. There's 87% of the market that's uninstitutionally owned, and we are all playing in that space. There's a lot of opportunity for continued consolidation and continued improvement. And to us, as a tech-enabled platform that's kind of facilitating that institutional ownership strategy as well as those long-term cash flow yields, it makes a ton of sense for us to be in the space.
Michael?
Yeah, I definitely agree with the growth in the industry. Pre-pandemic, I think the fad of the single-family homes was growing. I think during the pandemic, it grew even more. A lot of people living in apartments, dealing with, you're in a 2-bedroom apartment with 2 kids, and they're telling you not to leave. Everyone's like, the home would be a much better idea right now. A lot of people shifted, bought homes, you had lower rates. I also think the rate environment for the last 2 years, towards the end of COVID and before COVID, were historically very low. So it gave people an opportunity to go into these properties to get very good rates, whether it was a 30-year fixed or getting a 10-year interest-only ARM. The products worked very well for borrowers to grow their portfolios. Even with the higher rates today, there's still a high demand, especially middle of the country where there's higher rents, lower taxes. I think the other part of it is, to get into this space, your average operating cost is a lot lower than having a multifamily building. So if you're running on a multifamily, even if you're looking at the way an appraisal is conducted on it, how they're running the NOI, on a single family home, you're just looking at typically interest, taxes, insurance, and maybe a little bit of maintenance. You're not looking at vacancy factors or anything else when acquiring financing.
Property management fees, of course.
Property management fee, yeah. It's definitely helped this space grow a lot. We've seen a lot of our borrowers that were in the multi-space move over to the single-family rental space. We're about 10 years into this industry. I had borrowers that started with us with multifamily buildings in Brooklyn, and now they own 300-400 homes in Suffolk County and Long Island that they're all rented out towards the East End. A lot of people pivot their business plans.
Right. The first topic we're going to go into is lessons learned before and after COVID. As you guys know, there were winners and losers. There are states that were winners and losers. Texas happened to be a big beneficiary for immigration, and Florida was a big state that had a big winner for immigration. But I definitely think this space was a winner because of COVID. And we touched on it a couple times here and there with a couple panelists mentioning it, including Jackie, that what this did was it made people aware of how important where you live is. Before the pandemic, people were focused on their trips to Bali, going to do this, that, so they could take their Instagram photos, and they were focused on outside stuff and travel and spending their money on that. And then the pandemic hits, and all of a sudden they're relegated to their house, which is a 700-800 square foot apartment, and they're like, maybe living in this isn't so great after all. And my friends that have houses or larger space or backyards seem to be faring better mentally, physically, and they can work from home, and I don't have that ability in an apartment. My favorite thing that the pandemic did was it stopped the world for a minute, and it made people think. Now, some of the decisions they made weren't good, some of the decisions they made were good, but it made everybody stop and think about, is my life, the way I'm living it, the way I wanted to? Because everybody faced the thought of mortality. We thought maybe the world would end and this thing would kill everybody. So everybody at one moment or another thought, do I like my life the way it is? And people made the decision, I'm going to change it. And where they lived was one of those changes. So starting off with John, what were some of the lessons that you guys learned for COVID and then, of course, after COVID that are going to have long-lasting impacts on how you run your properties or what you guys do with your properties?
Great question. I would say there are two things. First of all, to your point, obviously the tailwinds in the industry were tremendous because of people primarily not needing to go to work physically and therefore feeling good about being farther away from center city and at the same time needing more space because they were at home and therefore really not being well served by being in an apartment. And as you said, that really changed the whole paradigm.
Now, if I'd ask a question with you when I direct this question, interesting enough, and while you're answering this, John, how were your occupancies before and after COVID? And did you guys see a meaningful influx of communities that may have been away from city centers or areas where people were concerned about being on top of high density?
Occupancy has actually been fine. It's actually gone up. It never really took a dip in COVID because the asset class that we were in had become so favorable. In fact, that's why rent have gone up and so forth. But the flip side of it is on the employee side. In 2019, I remember an offsite we had, actually it was in San Antonio, pretty close to here. We took the senior members of the firm and we're toying with the idea of remote work because we had, being in 60 locations, we had offices everywhere, and all of a sudden, boom, March of 2020, it wasn't a point anymore.
Right.
It was a mandate, and I think it's worked out wonderfully. There are a few exceptions to that where one of the beauties of having a business that spans the United States is all the different cultures that you have among your employee base. So there were certain very cohesive offices that I think suffered a bit from having to adjust to the concept of not going in every day and so forth. But generally speaking, we found the efficiency, the employee gratification and so forth of working remotely largely extremely positive.
Chris?
I agree. I think the drivers from the resident side are, I'm paying market premium maybe to live in a multifamily apartment. I've got all these fantastic amenities, but they're all closed and I can't use them. Why am I paying this premium? I'm going to go do something else. I'm also now working from home. I need some space for my home office. I want to segregate my living space and my working space. I know personally I work from home. That helps me a lot be much more productive. That's what we saw as driving factors into certain markets. I'm sure everyone on the panel here experienced this, where there were population shifts, honestly, density shifts from places like New York or legacy high rentership city environments like New York, where people were moving like, hey, I'm working from home now. Why am I going to pay to live in New York? I can't use any of the city amenities. What I'm paying this premium for doesn't make sense. I'm going to go be closer to my family in this area and I need some more space. I'm going to move to Atlanta, or I'm going to move to Charleston, or I'm going to move to Charlotte. And so we've seen certain markets actually become more appealing to our tenant base. Interestingly enough, those markets also correspond to markets that were from when I was talking earlier about the tier one rental investment in the SFR space. Those were the markets. They were markets that were generally more affordable. You had more space. And so we saw those shifts. And then I would just touch on the institutional side here, kind of pre and post pandemic. Pre-pandemic, if I was talking to a client and we were talking about deploying X $100 million into the space over the next 2 years, we'd probably be exploring 5 to 7 markets. It'd be places like Atlanta, Phoenix, Dallas, the big major metros. Post-pandemic, we're looking at those markets and saying, hey, yields are really tight. It probably makes sense for us to shift to secondary, tertiary markets. So we're thinking places like Huntsville, Birmingham, maybe Charlotte or Raleigh, places like that, where we're getting out of what are the more traditional, larger tier one MSA markets and into secondary, tertiary markets that have great assets. It's just not been prompted from this institutional expansion phase. And the pandemic drove a lot of that, again, following some of those employment and population movements.
Right. Jackie?
Yeah, I definitely concur. We're seeing a lot of the investors get very adventurous lately. A couple years ago, it was Atlanta, Tampa, the big five, but now we're opening a build-front community in Wilmington, North Carolina. Who's in Wilmington? Me. All right, you over there.
You're the other one.
So me and you are the only ones out there. But these institutional investors are really excited because everybody needs homes everywhere. It's not just these main 5, 10 cities. It's everywhere that people are looking for these scattered homes and the build-for-rent communities. So no matter what you're doing, do it somewhere because everybody's looking.
I just want to add there, because this is a property management conference, that property management presence in these markets really helps these institutional investors get in, because it means that they don't necessarily have to build to scale in a given market. They may be interested in piloting or going into, if there's a property management firm that they trust and know can operate for them, at least in the interim.
We're going to go ahead and switch up topics, and we're going to go ahead and start with you, Michael, since this is your area of expertise. It's the finance side. Obviously, everybody's concerned. We're seeing lots of major rate shifts and so on and so forth. But I think the interesting thing is, though, for this space, that it actually is almost, it's very intuitive to understand that as rates go up, it makes buying homes more difficult. So if you take that 45% of all renters that wanted to buy homes, that still always want to buy homes, and it put the ownership farther out of reach, but they still have the same need to fill that void, where are they going to go? They're going to go to rent because it's the only thing they can. So how is the finance world in today's situation, given everything that's happened recently with the Fed and so on and so forth, and just wanted to see what the panelists thought about what's going on in that space. Go ahead, Mike.
It was definitely a lot more fun maybe 6 months ago. I think everyone in this space was getting used to seeing numbers like even 2%, but mostly in that 3 to 4% on your rental loans. Those obviously gone up. You're seeing rates anywhere from 6.5% to 9% on 30-year financing. That and the conventional world now that you mentioned, conventional rates, you're seeing topping out. You have rates now at 7%. For that home buyer, typically if they were going to buy a $600,000 home, that takes them down to being able to buy like a $350,000 home. It kind of cuts in half what they would be able to afford. Based on what's on the market also, you have a shortage of homes. If they can do the work, not do the work to the home themselves as the home buyer, it really takes out a big chunk of availability for home buyers in general. So that did open up a lot of space in the rental market, and people that are in the space buying the rental properties, they are still focused on them, they're still buying them. At the end of the day, rates are always fluctuating. We have borrowers, when we first started rental loans about 6 years ago, the rates were in the 7s. Borrowers took loans at 7, bought a lot of properties, and they refinanced out at anywhere from 4 to 5%, cashed their money out when values went up. A lot of people are saying there's volatility. We don't know when rates are going to go down. Rates always go through cycles. I'm not going to give away my age right now, but everyone thinks I'm younger than I am, and they say, you've never seen it, and paid 15% when I bought my first home. So right now it's 7%. You're looking at that, still a great rate, buy a home. Other people don't feel that way. A lot of investors got into this space in the last 3 years. So all they saw was rental loans at 4%. They saw fix and flip loans at 7.5%, 8%. When we first started the industry, we still saw those 7% rates on rentals, and we saw fix and flip at 12. A lot of old borrowers, old investors have come back, and they're comfortable with those rates because they know the spreads, they know the markets, and right now it's a very opportunistic market. If you have the risk tolerance and you're able to buy something at a discount, you're going to see foreclosures coming back, you're going to see a lot of short sales, you're going to see a lot of opportunities to buy homes. You might see a higher rate right now, but if you're buying it at a discount and know you'll be able to refinance in a couple years, it's definitely. I've seen a couple cycles within the last 10 years, especially through COVID. We went from doing $100 million a month in loans down to zero in a week. And then it came back and it went back up to that number, and then it came down, and it also took a lot of money out of the market. Institutionally, institutions are making a lot more money on credit default swaps and other spaces where they don't want to put the money into this space, and there's a lot less bonds trading. So you'll see those adjustments, but they'll end up coming back. It always does. There's also a shortage of housing. I think everyone always talks about it. And we were at an IMN Build to Rent conference, and everyone still seemed very bearish at that conference a couple of weeks ago in Las Vegas, with plans to building several companies saying we're building a couple thousand homes this year, from people getting into the space saying we're building 200. And then to speak up about the markets, we are based in the Northeast and did a lot in New York, and we saw a lot of investors move during the pandemic. And places like St. Louis, Missouri. Historically, a lot of people said, oh, Nashville, let's go build and rent in Nashville. But then we saw applications in Memphis spike. So it was a different market, the tertiary markets they were talking about. And if you go look at Memphis, it looks completely different than maybe it did 3-4 years ago. You're seeing areas in Philly where people maybe would have never touched, like Reading, Pennsylvania, other places like that. People were able to go into it. How many people in here have gone to Baltimore for single-family homes? So Baltimore, big area, switches from block to block. We've done a ton of loans there, but a lot of people went into there. People thought they would never go into there. Places in Florida, inland, as Florida on the outside started running out of space, people going to Ocala and other places, and you're like, all right. I think this market changed a lot during the last couple of years. I don't think it's going to go away. I think it's probably going to grow in the next couple of years as well. Excited to see where it actually grows to. And I also think on the property management side, I think a lot of that has changed, creating a much better user experience for single-family home renters. Whether it's creating amenities, whether it's someone buying within a block and giving out perks to the people that rent from their management company, I think it's definitely helped.
Good. Anybody else have any comments they want to make about finance before we go to the next topic? Chris, go ahead.
I just definitely add, as we were talking about, the headwinds are definitely impacting the retail homeowner. I want to go purchase a home. It's more difficult for me to do so. The same happens for our institutional clients. On the acquisition side, it's difficult to go deploy capital today, hence the flight to secondary, tertiary markets like we're talking about. The other side is the difficulty for a retail homeowner generally halts the home price appreciation. And so what we're seeing is home prices actually start to level out across the US, but rent growth still remains really strong. I'm sure many of you are seeing that rent growth year over year for units that you're turning is still quite solid, and that's fantastic. And so what we're seeing is actually cap rate expansion on the book of business across the country, doesn't matter the market that we're talking in, because of rent growth. So despite the fact that some of the new entrants that we were talking about, they're looking for maybe a higher yield, we're getting that because of rent growth, not necessarily from asset price depreciation yet. And so what my view is, there's been a slight shift between Las Vegas and here, is maybe much more bearish because of uncertainty in Las Vegas. Now we're starting to shift to where people are starting to get through the uncertainty. We're getting comfortable with 6 to 7% interest costs, and we're starting to see the cap rates expand to a place where those deals actually work. And so buyers are just having to be a little bit more scrutinous with what they're going to purchase, but it's definitely impacting the market in what I would view as a positive way.
So we have 4 or 5 different impacts of this rate rise, which I agree could be relatively short to medium term. But first of all, on the buy side, there's less retail end user buyers now because of rates, so that's taken away the biggest part of the competition for buying homes. We have something called involuntary landlords that really is one of the ways the property management business got created, which was back in before 2010 and the Great Recession and all that stuff. People needed to move, but they didn't want to sell into a bad market, and therefore they wanted to rent out their house. They needed someone to do that for them, to manage the house. We're beginning to see that come back because for different reasons, not because there's a recession at this point necessarily, but because it's very expensive to sell your house at this point if you've got good debt on it. And it's also expensive to buy another house because house prices have grown a lot. So we're seeing that come back for the same reason we're seeing less churn out of our portfolio, because one of the biggest issues in property management, as everyone here knows, is when your retail client base starts to see how hot the market is, particularly these old involuntary landlords, they hit the bid and they sell, and all of a sudden you lost that property management unit. That's slowing down as well. Finally, on the institutional side, about a third of our book at this point is institutional. We're growing very fast on the institutional side because of our scale and presence and the way we do things, which continues to get better. It's certainly not perfect, but those guys can see the long picture. They can sustain even negative leverage where their debt costs are higher than cap rates. A lot of them are waiting right now, a little bit. No one's stopping. They're pausing because they're seeing cap rates are going to go up. They see the blood in the water, as it were, opportunity to add value, let's put it that way. So all of our institutional clients and ourselves as a joint venture operator are kind of girding for a lot of activity in the fourth quarter and early next year.
All right, guys, we're going to switch topics now and talk about investor trends. The good news is, guys, with all this uncertainty going in the world, we are a hierarchy of need. You don't have to have a lot of the things people have today, but you need a place to live, and we're there. So when people are paring down their bills they got to pay, you're usually at the top of the list, and that's better than being in something else that people don't need. So let's talk about investor trends. I think my first question to the panel is, what deals are getting done today? What kind of deals are people actually doing? And if you want to throw out some metrics, they're looking for this kind of equity multiple, they're looking for this kind of IRR, and what markets they're looking in. And clearly, this is a need everywhere. I think we've established that. People need new housing all the time. There's a shortage in housing. Our housing is getting dilapidated and old, and all these things going on in the marketplace. So, Chris, I'll go ahead and start with you on this one. What are you seeing in the marketplace as far as investor trends are concerned?
A lot. I'd say, first and foremost, I'll share some metrics. We're probably looking for cap rates 50 to 75 basis points higher than what we were looking for last year at this time, and that's kind of geographic agnostic. We're probably looking for mid-teen IRRs on a levered basis right now, give or take, depending on the market. We're also seeing a shift in risk appetite. So historically, when I say risk appetite, what I mean is, where do I want to invest in the J-curve of a return profile for a rental property? Buying it, renovating it, operating it as a stabilized asset long term. The shift up the curve allows you to take on more risk, but also generate significantly higher returns because you're adding value through renovation. Maybe when you do your post-renovation BPO, you're getting some juice off your leverage. That still feels really good, and we're seeing people kind of make that shift. And I'm seeing a dichotomy in the space where there's actually two players. There's folks that like development risk, and there's folks that don't want development risk at all, and they just want to purchase stabilized assets long term. And so definitely seeing that shift, and again, that's kind of investor dependent, client dependent. And then I've mentioned this a few times, but I'll just reiterate, the flight to different markets, the diversification, the ability to say, ooh, pricing got really, really hot in Phoenix, I'm going to stop purchasing there, pause purchasing there, as John was saying, and shift my deployment to another target market in the US. Having a very dynamic operating partner who can make those shifts with you as things change and evolve is very advantageous to our clients right now.
Jackie, what are you seeing?
Yeah, cap rates are exactly what you said and what they're looking at. But one of the big things that we're seeing, especially with institutional money from over in Europe, is they're really focused on what are you doing for ESG. Environmental, social, and governance are huge for them. They want to know what you're doing to make the environment better. How are you saving people money? What kind of social programs are you putting in place? And what kind of governance that you have to operate your business? Those are huge for them right now. So if you are going after institutional money, make sure that you have a plan together to address all of those issues.
John?
I agree with what everyone said.
All right, Mike.
I think it's very important if you're looking into a property right now. A lot of times you'll look at the higher rate and be like, I'm not going to buy this property, the rate's high. Compare it to the rate you had 3 months ago. A lot of times it's like a $50 difference in your monthly payment. That might adjust your return on investment, but I think it's important to look at that. A lot of people just look at the first number and they don't compare the two sides. So definitely important to look at that when you're looking at deals. And definitely, as I mentioned, don't be scared of new markets. I think people have made very good opportunities. I've seen that in the last 2 years coming out of the pandemic. Borrowers that I never thought would leave New York were comfortable in other places and actually doing a lot better. They're happier. They're not dealing with bureaucracy and other things that they might have in other places. And definitely, I think it's very important. She mentioned the environmental social governance. A lot of the borrowers that we work with in bulk, we will make sure to go to those towns and give back as well. So make sure you're part of the community. Make sure that people know you, even if you're the landlord. And if you're going to go into places, sometimes go meet the town hall, meet the DOB, meet everyone there. That's going to change how you grow within that community, within that town. They know you're not only there to collect rent, but you're involved within that community. It's going to help you guys with your tenants. It's going to help with the area you're in.
Great. So we have about 15 minutes left. The last 10 minutes, we're going to have a Q&A session where we ask you guys some questions. So be gearing up who you want to ask and what you'd like to ask. But before we go there, I'm going to ask the panelists to get out your cloudy crystal balls and to give the folks in the audience, based on all the things you see in the market, what do you see the next 12 months playing out in the market with respect to interest rates, recession, job loss, and these various topics? And go ahead and start with John.
So, yeah, no one's got a clear crystal ball for sure.
That's why I called them all cloudy.
Right. If someone were trying to predict something 9 months ago, they'd look foolish.
Yeah, they really,
right
yeah.
now. But obviously, the economy's not in great shape. So far, we've had very little evidence of fragility in terms of collections or anything like that. We are seeing fewer move-outs. Our turnover rate's gone down. I think people are getting more conservative in their appetites for personal risk. I think that the shift to institutional as opposed to mom and pop investors is going to continue because of the financing environment and because you need pretty decent footings in order to be able to sustain some of the headwinds that are going on right now, but it's still a great strategic play. And I think, as I said, there's going to be a lot less sales out of the property management portfolios. A lot of our institutional clients are borrowing short-term and or capping their exposure because they think that in 3 years or so, rates are going to come back down. So no one wants to lock in at high rates right now. So smart people are managing the financing environment and really looking for that expansion of cap rates to really get back in with both feet. I mean, with 5 million homes that are not built that are needed in this country, I don't see any meaningful reduction of rent rates. I do see the historically astronomical double-digit increases over the last year slowing down. We're seeing that happening, and I think that's going to continue. And that's market specific, so in some markets there may be some rent decreases, but generally speaking, very strong rent growth. There's still a big loss to lease aspect where people have historically leased homes and owners, particularly small owners, have managed occupancy versus income, so they didn't want to raise rents. There's a lot of opportunity to raise rents compassionately, but it's not a charity, a rental home.
Well, you got to keep pace with inflation because all your costs are going up. So
Right.
if you don't increase rents, you're just accepting lower margins. But anyway.
Right. So I really see a lot of very strong fundamentals continuing on the SFR side. I think we're all getting better at what we do. So this whole dynamic that we've been talking about here about efficiency and technology and making the rental experience for both investors and residents more seamless and better and more institutional is just going to continue to buoy this industry. And we're all going to realize the vision we have, which is to transform the industry so that scattered site or BTR, BFR is really just as efficient and can trade at the same multiples and cap rates.
The first thing we all need to decide on is what acronym we're going to use.
Yeah, right.
Because there's like 30 for this space.
BTR.
SDR, BDR, there's all over. We should just all agree we're going to call it one thing. That would be a good start. Chris, what are your thoughts?
I agree with just about everything that John said. The only thing I would add is I think we probably still have 12 months or so of pretty strong rent growth. Again, that's speaking to the loss to lease that exists on the portfolios today. Those leases we signed last year that are up for renewal, they had 12% rent growth in Atlanta. In some markets, we can capture that on the turn right now. I think there's still some room in the portfolios existing, but definitely if we're purchasing an asset today, we are not underwriting 12% rent growth in year one. That doesn't make any sense. Yeah. So I definitely see that. I see capital starting to get back into the space today, but again, slowly and selectively, and really kind of skimming the cream of the crop. The deals that work, great. The deals that don't, will pass. We'll wait to go out and force maybe next year. So we're kind of targeting Q1, Q2 of next year as when things start to stabilize, as the rent growth continues to kind of push cap rates out. Maybe home prices come down a little bit over the slow season here, and then we're ready to go Q1, Q2. That feels good. Where we are focused on for our clients is developing our operational efficiencies. How can we help them expand their operating margins, not sacrificing our margins, but how do we expand margins for our clients such that that NOI that maybe we can add an extra $150 a month to their property so that that deal works, whereas it might not have worked if we didn't do that. And then we say this term of the industry becomes institutional. I want to spend a second just talking about what that means to me personally. That means providing more transparency and more oversight into what we're doing. Having had experience working with both our retail book and our institutional book, they all want the same thing. They want to know what's going on with my property at all times, every day. Is it occupied? When's it going to be occupied? What's the rental rate, etc. And where we're focused on is driving those efficiencies, but also showing folks this is what's going on with your portfolio right now, today. And that's proven to be very valuable because then folks can actually make investment decisions. They're not constantly riding our team to understand operational performance problems.
Right. You know, one thing I'll throw as an overarching comment is I think one of the things that's a backdrop to all this stuff in the economy is that I think people recognize that this hyperinflationary period was somewhat of a self-inflicted wound. I mean, I'm not criticizing the decisions that the country made or any of the countries made that got us to where we're at, because they did the best they could with what they had at the time, and they did what they did to keep people going and paying bills and not have a cataclysmic event. But I think people recognize, and I think you see it in cap rates. You've probably never seen a move in interest rates like this without cap rates moving right up behind it. And I think that speaks to the fact that people who own these assets understand the intrinsic value of them, and they're not going to trade them at super discounts unless there's a special situation that makes them make the trade to get rid of it, because they really understand what the underlying value of the asset is. Right. They recognize this is a temporary blip, and that to everybody out here, if you haven't been through a cycle, it always comes back stronger. If you can hang on and hold on to your asset when you get on the other side of a recession or an increased interest rate environment, the value of the real estate always comes back much, much, much stronger at the end of the day as it survives, because people get more confident in that. We have just about a little under 8 minutes left, so I know we didn't get to everybody, but I think you guys want to open it up to some questions to the audience.
I have one preemptive question, comment, which is that, as I've said several times, this is a property management conference, and I'm glad IMN decided to dedicate a conference to this. The reason we got into property management first as opposed to investing is that we thought that was the hardest nut to crack, the hardest piece of the puzzle. And I think that the reasons the investors are able to go into all these new markets, the more adventuresome markets and so forth, is because the property management industry has preceded them, gone where the puck was going to go and so forth. We've done 28 acquisitions since we started. A lot of our growth is institutional now, but most of our growth has been acquisitions, and we look at those as partnerships, where basically we're taking the best we can find, the best operators in the markets, and we're paying top dollar because we're paying what those companies are worth to us as opposed to what their lagging EBITDA might have been or whatever. And we see it as a two-way street because we learn. The beauty of a platform growth approach like that is that you learn from the people that are joining you. So yes, of course, you have to standardize, and when we learn something, we roll it out across the whole country if it makes sense. That's why this kind of get-together is so rich for us, because we see all the people out there that are doing what we do and that could potentially become partners with us.
Great. All right, we'll open up some questions. Who's got some questions in the audience? Yes, you.
Hi, we're from HHC Homes. We're going to start our build-to-rent property in Rogers area in Arkansas. My first question will be, what kind of floor plan will be the most favorable to the market? Because I know lots of people are coming down, from buying a house, instead of buying a house, they want to rent. So usually those are served purpose for families, then I would say like 3 bedrooms. But I don't know if it's efficient enough for families who really want to, save up their money for, when the market recession kind of turn around, they want to buy houses. Or you think 2 bedrooms will be the best. So just wanted to.
Who'd like to take that?
I'll take it.
Jackie, go ahead.
I would say that there's no silver bullet. It used to be we're all looking for a 3-2. That's what the American dream was. But there are so many different families that you're going to find that it's important to have a good unit mix and do some research on what your average family size is like there. What used to be really popular in the 3 bedrooms, we used to sell those like hotcakes, no problem. But then with the pandemic and everyone wanted to work from home, everybody wanted a 4 bedroom. And a 5 bedroom. So now we can't keep our 4 bedrooms in stock, but we can still get through our 3 bedrooms. But that doesn't mean there's not a demand for the 2 bedrooms for the single guy who has a house and still wants an office. So I really think unit mix is important. I wouldn't just go with one house because you're going to miss a big portion of people.
I'd add that the home office is really important. It doesn't necessarily have to be a bedroom. I've seen great success with a 3-2 and a den, or a 3-2.5 and a den. Some other functional space inside the home. It's a multi-purpose space. It can be a kid's room, it could be an office, it can be a craft room, but that extra designated working space I've seen very important. I'd also say the jury's still out on amenities. We didn't really talk about BTR amenities on the stage, but is your community going to have a fitness center, a pool? Is it going to be one of those higher amenitized communities? Or is it less amenitized, meaning like a dog park, maybe a walking path? I think that comes down to Jackie's point of understanding your market demographic. Who is our target tenant base and what does that tenant base need? And then providing the right product to fit that need.
Right. I've even seen them where they've taken out a closet and instead of the closet, put in a nice big desk area so that you could save some space. It works.
All right, next question.
You have some down there, do you want to?
Oh, yeah. What does the role of technology play in your property management ambitions? Specifically, are you looking at comprehensive platforms or singular point solutions?
Oh, man.
I'll start with that. And I think we have some diverse opinions on the panel, which is great. We at Home River Group consider ourselves a property management company, first and foremost, technology being probably the most critical, perhaps after human capital, aspect of how we're going to get better and how we're going to do all the things we're talking about in terms of transforming the industry. We've chosen not to spend the time, money, and energy to build a holistic platform that's proprietary of our own. We have enough faith in the property melds, the tenant turners, the fine digs, the Z inspector, all those guys, and we've pivoted within that group, by the way, so we remain very flexible in terms of the ancillary things that we add on to that, and most importantly, we have built a proprietary analytical and operational tool that weaves all these things together, and so we're constantly on the lookout for good new technology, but we're not building our own, as opposed to some of the other guys on the panel here.
So we built our own.
All right.
So I'd say like the comprehensive platform, we see an advantage with that to a certain extent. When I say comprehensive platform, what that means for Darwin is our operating software is comprehensive, meaning a property that we acquire all the way through whenever it leaves the platform never leaves a system. It stays on the same thing. Workflows are housed within that system. What that allows us to do is build a lot of efficiencies, or what we perceive as efficiencies, where task A can be completed by person A and person B doesn't have to get an email or no, the system automatically tells them to go do this thing. That's helping us with the staffing issues. As we grow, we've had a period of rapid growth. For those of you that have been following, we added something like 3,500 doors last year, which doubled our size, or almost tripled our size. It's been quite extreme, and so we've needed that technology support to help us facilitate that level of growth. That being said, there are other best-in-class service providers that we absolutely plug into to help us achieve scale, to help us grow, until we maybe go internalize, say, like maintenance. There's a question on here about maintenance trends and how we find people in different markets. I'll speak to that for a second. We take our approach of find best-in-class service providers and then understand what our runway to scale looks like in that market, and then determine when do we need to internalize, say, like a maintenance vendor as a W-2 employee or something like that. So definitely, from our perspective, comprehensive platforms are helpful. I think an off-the-shelf comprehensive platform is very difficult to find. So to John's point, it is a capital investment. It is a major undertaking to do that, but we find some value in it.
Yeah, I don't think there really is a single point solution that's going to have everything in it. I've been on every platform.
Well, they tell you it is.
Everyone
They
tells
sell
you.
you that it's a single point. It doesn't actually work.
It doesn't actually do everything.
everything.
You always got to pull from different vendors and merge them all together. Make sure you're on a platform that can actually integrate with all of those different players. But yeah, there is no single point. We're actually right in the middle of a transition right now. And I can tell you it's difficult, but it's important to get that technology in place, but not only just the base property management system, but being able to utilize data visualization, your Power BIs, your Tableaus of the world, to be able to see everything that's happening all at once at a glance and pinpoint where your issues are. And you can't always do that with a lot of these single point solutions that are out there. So building on top of that with a data warehousing product and a visualization product is really going to elevate your business.
Right.
Well, guys, it looks like we're over time today. I want to thank all the panelists for being here today. You guys did an excellent job, and thank all you guys for being here today, and have a good rest of your day. Thank you.
Yeah.